Hi, good afternoon. My name is Anthony Prowlis. Today I'll be discussing different hedging strategies that we can use and implement via various options or derivative strategies. We'll take a look at some of these and determine if we could implement these into the Smith's current portfolio. So to begin, derivatives not only serve as investments of speculation, but can also serve as hedges in a portfolio by offsetting the risk of the underlying investment losing value. The three strategies we'll be discussing are a protected put, a covered call, and an equity swap. Once we've looked at these strategies and defined them, we'll then outline some of the advantages and the disadvantages, as well as discuss a real life example that can be applied to the Smith's current holding in Cornelius Inc. stock. So to begin, a protected put essentially serves as insurance in providing downside protection on a long position. The strategy is constructed by combining a long position in a security or portfolio and a long put option. The long put option gives the investor the right to sell their shares at the strike price. And then the long put also provides downside protection in the event that the long security position decreases in value, which would then offset and serve as a hedging strategy. The second strategy we're looking at is a covered call. A covered call entails writing a call or selling a call against 100 shares of an underlying security. The 100 shares effectively serve as collateral if an investor is assigned and must serve their obligation to sell those 100 shares at the strike price. This strategy involves the investor collecting premium for selling the call, which they actually get to keep if the option expires worthless. If the underlying security is actually above the strike price anytime up until expiration, they could potentially be assigned and have to serve their obligation to sell those shares at the strike. This strategy is most successful when the expected volatility in the underlying stock is deemed to be low. And then lastly, the third strategy we'll be looking at is an equity swap. An equity swap is an over-the-counter agreement that allows investors to exchange returns on equity securities or to exchange returns on equity indexes. This allows the investor to diversify their portfolio through exposure to the performance of the index while still holding their equity. And then the cash flows can be scheduled over certain periods of times per the agreement rather than being fixed on a certain date. Now moving into some of the advantages and disadvantages of these three strategies. To begin, some of the advantages of a protected put are that they can offer a hedge or protection on a long position for the cost of the option premium that's paid. Essentially, you pay the premium, you thus get the insurance or protection on your position. Another advantage is that if the underlying security decreases in value, the put option will actually gain value, thus offsetting those losses in the portfolio. And then the protected put also gives the investor the right to sell their stock at the strike price via exercise should the underlying stock lose value. What this might look like is if I have a $30 strike put and my stock has decreased to $25, I can exercise my right to sell those shares at $30 rather than at the prevailing market price of $25. Some of the disadvantages of these strategies are that the option could potentially expire worthless should the underlying stock go up, thus resulting in the max loss being realized, which would actually be the premium we paid to put on the contract. And then another disadvantage is that we're actually paying a net debit to put on this strategy rather than receiving a credit through premium, which may actually eat into our profit margins. Now moving into some of the advantages and disadvantages of covered calls. Some of the advantages are that investors collect premium through selling the call option, thus resulting in positive cash flow income to their portfolio. Another advantage is that loss is limited since the underlying security serves as collateral in the strategy should the investor be assigned and have their shares called away. This is in contrast to naked calls, which are essentially the same strategy in selling calls. However, those naked calls do not have the underlying 100 shares as the collateral, thus exposing investors into unlimited risk in their accounts. Another advantage is that investors get to actually keep the premium should their option expire worthless. Now, in contrast, some of the disadvantages of a covered call is that the upside potential is limited in the event that the underlying stock increases dramatically. And then another disadvantage, of course, is you may actually have your shares called away if you're assigned on your short option position. Now moving into some of the advantages and disadvantages of equity swaps. Some of the advantages are that it allows an investor to diversify their portfolio through the agreement by exchanging cash flow on their equity position with that of a benchmark index such as the S&P 500. And then it also involves a series of cash flows over time versus that of similar derivatives such as forward contracts, which usually only have single settlements. And then some of the disadvantages are that since the returns are tied to the performance of an index, investors may lose more money if they just held rather than if they just held their position. And then another disadvantage is that due to the complexity of these contracts as well as the volatility that is associated, these are not suitable for every investor, and investors should be cognizant of the risk associated prior to entering into these strategies. Now, moving into some of the examples in reference to the Smith's Cornelius stock. We'll start with a protected put one. So we currently have 1,000 shares of Cornelius Inc. stock, which recently closed at $28.87 per share. To hedge our position, we have determined that we want to purchase protected puts to protect the 1,000 shares on the downside. We've settled on the $29 strike put, which is expiring February 12th, 2021, and it's currently trading at a premium of $2.70 per share. Now, because these are long puts, these puts will give us the right to sell our shares at the strike price should we choose to exercise, and will offset any position depreciation as these puts will become more profitable if our actual underlying stock loses value. So from a transaction basis, what this will look like is we have our 1,000 shares of Cornelius stock at $28.87. This serves as our long position, so that's step one. Next, we'll buy our put contracts or our protected puts. Since we have 1,000 shares, we'll be buying 10 contracts of the $29 strike puts, which are expiring on February 12th, 2021 at $2.70. Now, since we know that each contract represents 100 shares of the underlying security, we'll be taking that $2.70 per share, multiplying it by $100, which will give us a premium of $270 net debit that we'll be paying for each put. Now, since we're buying 10 puts, we want to multiply that by 10, and that will result in a net debit of $2,700 for us to purchase our protected puts or insurance on our long position. Now, some of the outcomes, of course, are if the underlying stock increases in price, then that will happen. Our stock position will increase, and our puts will more than likely lose value, thus putting us at risk of our options expiring worthless, which results in us losing the net premium that we paid. So the $2,700, we could potentially lose that if it expires worthless. Alternatively, if the stock ends up decreasing below our strike price, which we have the $29 strike, we could potentially exercise our right to sell our 1,000 shares of Cornelius stock at our strike. What that might look like is if Cornelius ends up decreasing to $20 per share, we could exercise our right to sell our 1,000 shares at our strike of $29, thus getting a better deal than if we were to sell those 1,000 shares at the prevailing market price. So this would be a protected put example. The next example we'll look at is for a covered call. So same thing, we have 1,000 shares of Cornelius stock, and we'd like to go ahead and open a covered call position to generate income. We're interested in the $30 strike calls, which are expiring on the same date, February 12th, 2021. And they're currently trading at $1.80 per share. So since we actually know that we are selling these, we'll be collecting $1.80 per share. If the option expires worthless, then we actually get to keep that premium. And if the stock increases and has a strong uptrend, we may potentially be assigned and have to sell our securities or our shares at the strike price. So from a transaction basis, what this would look like is we have our 1,000 long shares of Cornelius. We'll be selling 10 contracts to fully cover our position. So we're selling to open 10 $30 strike Cornelius calls, which are expiring on February 12th, 2021 for a net credit of $1.80 per share. Now, since we know that one contract represents 100 shares, we'll multiply the $1.80 by 100, resulting in $180 premium per contract. And since we're selling 10 of these to fully cover our 1,000 shares, we'll be collecting a total of $1,800 in premium for the entire position. Now, some of the outcomes here, if the stock decreases or remains flat, then we get to keep that premium, and our option will most likely expire worthless. Alternatively, if the stock increases, we may potentially be assigned on our position and have to deliver our shares at the strike price. So since we have the $30 strike, we'd have to sell our shares at $30, regardless of how high the actual underlying shares may have risen. So potentially, maybe this gets really deep in the money and Cornelius is trading at $40. If we get assigned, we have to deliver our obligation to sell those shares to whoever exercised against us at $30. The premium we collected will offset it a bit, but we'll still be having a small loss in that position. So this would be an example of a covered call. Now, lastly, we'll be taking a look at an equity swap example. So we're interested in potentially diversifying our portfolio by entering an equity swap agreement with Major Lending Bank, which will swap the returns of our 1,000 shares of Cornelius Inc. in exchange for the returns of the S&P 500 index. It's actually going to be through the SPY ETF, which tracks the S&P 500 index. This will include all capital gains and losses, as well as any dividend payments. And then the notional principal will be $28,870 even, and the settlement will occur currently. So the transaction would look something like this, and I have a chart here to kind of reference how it would divvy up. So we'll be swapping the returns of our Cornelius stock for the returns of the SPY ETF. Since we receive $220 in dividends annually, we'll be paying $55 quarterly in exchange for the SPY quarterly return. This chart references the 2020 performance of SPY, which will give us kind of an idea of what this would look like. In quarter one, we see that SPY lost 19.43%. In quarter two, it gained 20.16%. In quarter three, it gained 9.04%. And then in quarter four, it gained 12.12%. Now, how this would divvy up is each quarter we're paying our fixed payment of $55, which is our quarterly dividend that we receive on our 1,000 shares. We then take into consideration the floating payment. Now, this is what's derived from the benchmark returns or the SPY returns. Now, in quarter one, since we lost 19.43%, we would take the notional value of $28,870, multiply it by the 19.43, which would give us a negative $5,609.44. After factoring that, plus the $55 that we already had to give up, that results in a net payment of negative $5,664.44. So we're in the hole for the quarter one. Quarter two, we have a stronger quarter. The SPY returns 20.16%. So we actually will get a net floating payment of $5,820.19. So this quarter, after taking into consideration the $55 that we paid in our fixed payment, we receive a net payment of positive $5,765.19. So we're about break even now for the year. In quarter three, we see that SPY returned 9.04%, so which will result in a floating payment positive $2,609.85. After factoring in the $55 fixed payment that we put up, we'll receive a net payment of $2,554.85. So we're in the green for another quarter there. And then in quarter four, we see that the SPY returned 12.12%, which result in a floating payment positive $3,499.04. And after factoring the fixed payment that we had to pay of $55, this result in a positive $3,444.04. So for the most part, you can see how one bad quarter or negative returns could drastically affect the returns in this. For the year, we were positive. However, that first quarter definitely held us back in terms of the returns that we may have been able to reap. So in conclusion, in reviewing these three strategies in depth, the most suitable strategy, at least at this time, would be to implement cover calls or protected put strategies. Equity swaps may not be the most suitable, as the fixed payment via the Cornelius dividend payments are quite low in terms of capital, and we could potentially be wiped out if the S&P 500 took a large drop, such as in that quarter one that we saw in 2020. The protected put and cover call strategies would give the Smiths a chance to either hedge their portfolios on the downside if their stock loses value, or to collect premium by selling those call options. Both strategies aren't necessarily riskless, but they do reduce risk by a great degree. I recommend starting with the covered calls to generate income, which can then be used to open up protected puts, which they will actually need to pay for since we're paying the premium on those. If they would potentially like exposure to both strategies, they could potentially investigate callers, which basically combine that long position that we have in the 1,000 shares of Cornelius. We're buying a protected put, and we're also selling a covered call. With that being said, however, we will continue to monitor how these strategies fit the overall goals and objectives of the portfolios prior to implementing those. Thank you.